uh, doing this with students in class who have come to class, that this is a pretty lengthy chapter. You know, you've got 95 slides, so we don't have much time to discuss other than what's on chapter today. But we might not have to go through each and every slide, because this is a concept that I'm sure all of you are pretty aware of and must have tackled in some way or the other in your undergrad study, maybe several years. But let me just ask, how many of you are still pretty refreshed about time value of money, the formulas, and also how to work on questions? So everybody is shaking their head in the class. Students online? So I'm not getting a very encouraging response. So that's fine. Let's then continue and go over the important aspects of time value of money. Before I actually just jump into time value of money, what is essentially meant by time value of money? I mean, why do we have this whole notion of time value of money, or the fact that there is a value associated with money that is impacted by time? So that's, you know, a student in class, you know, he's made a valid point that the notion that time presents a value to money is primarily coming from the fact that if I forego any current consumption and save it or lend it, I should be compensated for it. You know, there's an opportunity cost associated with foregoing that consumption, so I should be compensated for it. And that can be associated to the notion of time value of money. That $1 today is not equal to $1 in a year's time. I mean, if, for example, I would borrow $100 from you and return $100 back to you in 1 year, just on purely business terms, not, you know, as a friend or a relative, would that be fair? No, because you are foregoing your current consumption of $100 and lending it to me, so you should be compensated with a required rate of return, you know, which could be whatever is market rate plus some risk premium as we have discussed. So that brings us to the concept of the future value, present value, the rate of returns, and amortization. And these will be the concepts that we'll be discussing in class today. So again, the premise again draws from the fact that we are looking at the value, which is the present value based on future cash flows, and they're discounted by the weighted average cost of capital. So this goes on for n number of periods in future, which can be discounted to today's value. We already know the free cash flows would be the net operating profit after taxes less required investment in operating capital, and then the weighted average cost of capital can be associated with various factors such as market interest rates, market risk aversion, which would be the associated factors for the cost of debt and cost of equity. So the average of cost of debt and cost of equity is the weighted average cost of capital. We have already discussed this. So in this broader framework, we'll talk about the time value of money concept. So at a very basic, you know, if I had to look at the timeline, I mean, this is just a very basic that we introduce in the first finance class, is the cash flows. For example, if and the 0 is denoted for today, and 1 is basically a time period in future. It could be 1 day, 1 month, 1 quarter, 1 year, and these are at equal increments. So what cash flows are either incoming or outgoing, and they attract some I rate of return or some I cost of capital, depending on whether you're borrowing or lending. So the tick marks at the end of the period, so time 0 is today, time 1 is the end of the period 1 or the beginning of period 2, either way. So timeline for a lump sum, $100 lump sum due at end of second year can be denoted like this. This is today, first year starting point, second year. I'm sorry, this is going to be the first year. This is the end of first year, and then this is the end of the second year, and that is $100 lump sum due at end of year 2. Time value for an ordinary annuity for $100 for 3 years. Again, what's the difference between annuity and perpetuity? We discussed this in one of the classes before. Annuity and perpetuity. Perpetuity is forever, and the basic definition is some form of payment or some form of receipts which are in equal value, paid out at equal increment. Annuity will be for a fixed time period, perpetuity would be for infinite time periods. So in this case, it's an ordinary annuity because it's paid at end of the time period, so you can see this, and these are at equal increment, and the amount paid is fixed, which is $100 in this case. Okay, so far so clear, students online? Now in real world, what we have is uneven cash flows because you may want to save money, which is whatever money you can come up with, or you may be receiving from business an uneven cash flow. So let's say, for example, you pay $50 because negative means that money is going out. Positive means money comes in. So in this case, you paid $50 out at end of period 1, you're getting $100. At end of period 2, you're getting $75. And at end of period 3, you're getting $50. Again, these are some basic examples to make you familiar with the concept of timeline. So what would be the future value of initial $100 after 3 years, given that 10% rate of return is paid for your principal balance? Okay, Quincy says $130. Is that the right answer? No, that is not the right answer. Why? Exactly, Quincy, you have to take into effect the concept of compounding, which is going to be interest paid on interest. So interest has to be paid on interest. And let me show you this basic example here. Okay, students online, can you view the Excel worksheet that I'm sharing? So let's look at this basic example. So you have $100. At end of year 1, you'll be paid 10%. So this is going to be 100 multiplied by 1.1. That's 110. Now this is going to be the starting value for year 2, and that would be paid 10% as well. And this will be the starting point for year 3, and that would be paid 10% as well. So Quincy, do you see that? You said, and that was a good observation. So where is that $3 and 1 cent coming from or 10 cents coming from? That's interest paid on interest. Because let's say, Quincy, what you had said, let's say you have a bank account and the bank pays you $10 every year. So this is going to be 100. At end of year 1, it would have been 110. And what you do is you basically withdraw the interest paid, which is $10, so you're left with $100. So $10 have been withdrawn, and you start with $100 again. And that again is paid 110. I mean, the ending balance would be 10, left with 10 again. You withdraw 10 again, and then 100 again, 110, and then 10. So I'm sorry, in end it'll just be 110, nothing would be left. So this is 110 here. So your ending balance in this case with your interest over the years is going to be 130. So that $3.10 is coming because you left the interest as principal and interest is paid on this interest. And that's a very powerful concept because now that concept is used in a lot of practical applications like retirement accounts, insurance, pool, and all the investment. One interesting thing that we do with kids is if you could start saving with a penny and you doubled it every day, how many days will it take for you to become a millionaire? Yeah, penny. You double it every day. Double it like you are. If it's 1, then 2, then 4, then 16, like that. So let's do it. It's an interesting one. Let's say if it's 1, then it becomes 2. Okay, so it's 1, 1. So this is 2. So it'll be okay 4. So let's put the days also here. Four, and this would have been this raised to the power this. No. This raised to the power. No, it should be 16. Just a minute. Let me just do it again. Let's put dollar here so that we can. Okay, in 17 days, it's already $65,000. So it took 21 days to become a million. Okay. All right. So all right. So you guys are awake. Okay. All right. So let's. So in 24 days, it's 83,000. Then 27 days, it's 671,000. And it is under a month, 28 days. It'll be less than 28 days, between 27 and 28 days. Yeah. And this is to catch attention of kids, just to show them what the power of compounding, and also saving does help. And everybody's guessing 10 years, 20 years, 30 years, and then you show them this, and then they just get excited. So this is the whole concept of power of compounding. You earning interest over interest. And then again, remember we talked about the dividend reinvestment, that you let your dividend reinvest in the company and you get equal number of stocks for it. If you leave that over 15, 20 years in a company which is high growth company and is paying regular dividends, you probably will have your stock in terms of numbers have increased 6 or 7 times, depending on how much dividend is being paid. So this is exactly what we just covered. Students online, everyone clear? I mean, I just had that Excel as a fun exercise, just to kind of keep you engaged, so that you don't sleep off. So this is same thing after 2 years. Then this is 3 years. So in general, what we have is a simple formula for the future value, because what we have is a generic formula that is present value is equal to future cash flows divided by 1 plus R raised to the power T, or you can also put future value simply. That's the formula. And since you want to get future value, then this goes here. So future value is equal to present value multiplied with 1 plus R raised to the power T, which is the formula here. So that's the relationship between future value and present value. So you can see that as the rate of return goes up, it has a negative impact on present value. As the rate of return goes up, it has a positive impact on the future value. So there are 4 ways to find future value. One is step-by-step approach using timeline, as we have seen. Solve the equation with a regular calculator formula approach. So you can simply use the FV equals present value multiplied with 1 plus R raised to the power T. So for example, in our case, if you had to find the future value, it would be simply $100 multiplied with 1.1 raised to the power 3. That would give you 133.10. Or you can use a financial calculator, which I'll show you, and then use a spreadsheet, which I'll also demonstrate. How many of you already know how to use a financial calculator? All of you should. No? Okay. Well, let's look at the financial calculator first. Okay, students online, can you view the financial calculator emulator that I'm sharing? All right, for those of you who are not sure how to use a financial calculator, what you need are, for now, what you need to concentrate would be the third row from the top, which is N, IY, PV, PMT, and future value. So N relates to T, which is the time period, periodic time period, or number of time interest is charged or interest is paid. That's the technical, definition for N. It's the number of times interest is charged or number of times interest is paid. For example, if you have a car note for 5 years and you have to pay a monthly payment, what would be N? 5 years monthly payment. That would be 60. So N would be 60. But technically what you're doing is interest is being charged 60 times, right, throughout the loan period which you're paying. IY would be interest per year. That's IY. And you would have to do a treatment again depending on number of times interest is paid. For example, if the interest is quoted as annual percentage rate and it's a monthly payment, then you have to divide by 12. Okay. FV is future value and PMT is payment. One thing about payment which is important to understand is if money is going out, then it has to be left as negative. You have to put negative, that's money going out. When money comes in, then you put positive. Otherwise your solution may not work. If you get a wrong answer, check if your payment was plugged in as negative or positive. And FV is future value, what the future value would be. So the 5 are the core components for any time value of money question, and you got to know 4 out of 5 to solve for the 5th. If you only knew 3, would you have the answer? No, that will be a unknown solution because you got to know 4 out of 5 variables. 1 can be unknown to get a solution. So again, for the same question as we had just done, let's work out an example here. First thing you need to do is just press second reset, and it's already asking for reset question. Should I reset? And you press enter. And the reason you do that is because in a financial calculator, memory would hold numbers, for these registers like N, IY, present value, payment, and future value. So what you're doing is you're resetting any old set memory so that you don't get a wrong answer. So second reset, enter, and CE, which is clear all. So now, for example, in this 3-year example, what is N? Yeah. For the 3-year example we just did, what was N? 3, right? Because it's for 3 time periods. And then 80% of the task in any time value of money question is to identify variables. It's only 20% which is just plugging in the numbers and solving. So N is 3, so you start with pressing 3 followed by N. And now you know that 3 has been registered in N because if you see there's a little triangle or arrow which is pointing towards N. Students online, do you all see that? This one here. That would confirm that number 3 has been registered in the value N. What about IY? What was the interest rate there? 10. So just press 10 followed by IY. And since it's annual interest rate, so we don't have to divide by periodic periods. What about present value? 100, because that's the money you are saving. So it'll be 100, and since it's money going out, you will enter or press this plus minus button, and that makes it negative 100, followed by present value. What about payment? Are we getting any payments out? No. We're leaving all the money in the bank, so payment is 0. We can just skip payment. So now that we have all, taken in account all the 4 variables, now we can calculate the 5th. So what you do is press compute, which is CPT, followed by future value. And there's your answer, 133.10. So that's the way you will work on financial calculators. Okay, students online, everyone clear? Okay, let me also show you how to work this problem in Excel. If you're using Excel, in case you don't have access to a financial calculator. Okay, students online, can you all view the Excel worksheet that I'm sharing? All right, so, and this is what I like to do, in Excel, even though I can just use it in one cell, I still like to first identify the variables. So N is 3, IY is 10%, present value is -100, payment is 0, and future value we have to calculate, so I'll leave it blank. And for future value, you have a function called FV. So in Excel, anytime you want to invoke a function, you always start with an equal sign, followed with the function name, which is going to be F. So you can see that as soon as I started typing F, it's given me a list of all the functions available to me. So either, if you don't remember, you can always scroll down and see there's an FV function. So you can double click it and it can start your bracket and see it's asking for the inputs. And if you are familiar with the function, obviously you can just start with equal to FV, bracket open. The first thing it's asking is rate. So you will simply just click on the rate cell, followed with a comma. The next one is number of time periods, which is N. That's going to be 3, comma, payment is 0. There's no payment being made. Present value is 100, negative. Type is whether it's being paid at the beginning of the time period or end of the time period. In this case, it's end of the time period. Most questions would be end of the time period. So just put a 0 there. And it's also highlighting end of period. So just close the bracket, enter, and you get the same answer, which is 133.10. So it's up to you, whichever way you want to use. You want to use good old formula, you want to use financial calculator, or you want to use Excel. Okay, students online? All right, so let's get some examples here. Yeah. So you have to convert your interest in month. No, it won't work. Always you have to convert the interest rate. That's a good question. Let me give you a very practical example, and that will make it very clear. Let's try and calculate the payment for your car payment. Supposing if you want to finance a car, that everybody would do one point or the other. So how do you know what your payment would be? Before you, normally dealers will like to show that they're helping you out. But I'll show you what they do. So let's say, just give me an example. Let's again break down this by N. Okay, give me a car. Okay, give me a model, name and model. Toyota Camry. And what's going to be the value? Really? You can get for $2,500? Okay. All right. So let's make it $5,000, or $6,000 in good condition. Let's drive a nice car. So let's say the dealer is saying, I'll give you for $6,000, and he comes back and says, I can finance it at 3.99% for 5 years. So how can you calculate your payment? So let's do this example. And I like to, first identify the variables, because that gives me indication of what's known and what's unknown. And then plugging in the numbers is just 20% of the task. So in this case, what would be N, which is number of periods? It's a 5-year loan. So it'll be 5 multiplied with 12, because it's a monthly payment. Again, 5 years, monthly payment. About the interest rate. Now the interest rate per year is 3.99%, but you have to divide it by 12 to make it a monthly rate. So this is your monthly rate. Present value, the loan amount that you're financing is $6,000. So I'm just going to put $6,000 here. Payment, I don't know, so I'm going to leave it blank for now. Future value would be 0. You would have paid off your entire loan, right? So in Excel, you have a function called payment, PMT. Bracket open rate, just press on this cell. Number of periods is going to be 60. Present value is 6,000. Future value is 0. And type is 0. So your monthly payment should be $110.47. Right? But you say, hey, that's a little bit too much, I can't afford it. So the dealer says, give me a minute, I'm going to go and talk to the boss and see what I can do for you. He'll come back after half an hour, making you all anxious and everything, and says, hey, you're such a good friend, I'm your lucky one, I'm going to help out, and this is just for you if you buy the car today. We're going to bring down your monthly payment. And how do they do that? I mean, are they going to give money from their end? No. They will just increase the number of, from 5 years, they'll make it 7 years. So those are 84 payments. Everything else will remain the same. On the contrary, they might increase the interest rate to, let's say, 4.25. And this is going to be 6,000. And this is going to be 0. So you got $82.71. You will walk out happy. Yes, give me the car. I'm signing and taking the car today because I got it on $82.71. But what is the total cost of loan? It's going to be 110 here multiplied by 60 in this case. 60. So here you go. And here this is going to be 82 multiplied with 84. So you see that? So you're paying almost $300 more and you're walking out happy. You're thinking this dealer has really taken good care of me. I'm going to send more friends of mine. Yeah. So if you know exactly what's going on, you would be able to negotiate there. Yes, that's why they have those nice showrooms. And this is the trick that realtors, or when you buy a home, car loan is what? You're going to pay off in 5 years. You may lose a couple of $100 here and there. It's not that much of a cost. But home loan is something that you have to be really very careful because you're going to be stuck with it for 20 to 30 years. And a minute change in interest rate may mean several $1,000s. Let's take an example there. Let's say you found a home, worth what, $250,000, $250 million. Where we are in any average U.S. city, not in a rural area. Okay, if you want rural area, we can take what? Give me a number. 150,000. Okay, so it's going to be $150,000. That's the. All right. So N. Okay, so this is going to be what, 30-year loan? 30 multiplied by 12, 360. Interest rate, 4%. Prime, good credit. Let's look at what the going rate is. I mean, if you don't trust me, I guess my class doesn't trust me. So I'm the one teaching class all the tricks and they don't trust me. Okay, so let's see. Let me open up browser window. And this is a good site. I encourage all of you to visit this site when you're applying for any loans or something like that. Why isn't my browser coming up in the share? No, it should come here, in the share. Okay, let me open up Google. Okay, students online, can you view the browser window? There's a site called bankrate.com. And it gives you, good information about current rates on various things like credit cards, home loans, personal loans, car loans, refinancing, you name it. So 30-year fixed refinance is 3.83, which nobody can ever get because this is the published rate. But let's say, you are offered, so it's about, same thing, mortgage 30-year. Fixed rate is, did you see that? 30-year fixed is 3.79, refinance is 3.83. 3.79. So it's close to 4%. But let's say between 4 and 3.79. So you would say, hey, what's the difference between 4% and 3.79? Right? I'm not going to think about that much. It's close to 4%. That's what you're going to think. But let's see what the difference is in real terms. So all right, can everyone view the Excel worksheet again? So let's take the two scenarios. One is 4%, the other was 3.67, right? 79%. So this is also going to be 360. The only difference is this is going to be 4% divided by 12, and this is always put an equal sign, and this is going to be 3.79% divided by 12. Present value is the home value, the loan value. Future value is going to be 0. That would be the amount you would have paid off the loan. That means. And this is going to be payment. And I don't have to. I could have just done it in one cell. For example, I'll show you. So payment rate is this one here. Number of time periods 360. Present value is 150,000. Future value is 0. Type 0. So that's 716 for 4%. Let's see what's going to be for 3.79. Rate is this cell. Number of time periods 360. Present value 150. Future value 0. Type 0. 698.02. So what's the difference? Let's see. Absolute value of this minus. So that's $18.04. That's nothing, per month, right? Times 360. $6,494.59. So you are giving up that much of money over a period of time, right? You shouldn't even be giving away $1 because they're getting their processing fee, they're getting all the other fees, which is what it is. And this is the reason why you should also consider refinancing. For example, if you get a lower rate, you see that this is the amount of money for example, if your existing loan is at 4% and a bank offers you a refinance at 3.79, you'll be able to save over the years $6,494.59. One more thing we look at amortization is the period. That is, instead of 30 years, if you paid off in 15 years, for example. So let's say, and I'm just going to go to bank rate and see, the 15-year fixed rate is 2.93. So let's say so it's 2.93%, and this is for 15 years, which is going to be 15 multiplied by 12. That's 180 payments. Interest rate is 2.93 divided by 12. Present value is the same, and future value is same, 0. You would have paid off the entire loan. Payment is going to be the rate, number of time periods, present value, future value, type. So your monthly payment is 1030.83. But again, cost of loan is important. If you can manage 1030, let's see what the cost of loan would be. So you would have paid 1030.83 multiplied by 180, which is this amount. So this amount less 150. So this is the amount you paid in interest, 35,549 over the length of the loan. In case of 30 years, I'm just going to take 4%. That's the total amount you've paid. So you paid $107,804.26 in interest. So that's like buying another house, right? That's the reason why they love people who get into these long-term loans, car or home. Who are good customers for credit card companies? Yeah, but how do they define a good customer, credit card companies? No, they don't see the earning. They see if for example, I have a credit card, exactly, Jordan, if I have a credit card and if I pay my balance every month, I'm a bad customer for the company because I'm not paying any interest. A good customer for credit card company is the one who's always carrying balance and paying interest on the balance. They are the good customers for credit card companies because banks make money on interest rates. That's their source of revenue. The other source of revenue is all the loan processing fees they make. It can be close to what? On a $150,000 loan, they'll probably charge close to $7,000 to $8,000 on different fees. That's quite a bit of revenue for banks. Okay, students online, we'll be doing a lot more of examples, but for now, everything is clear with everyone on this example. Now, since we are here, since we've already discussed about the home payment, let me also discuss amortization. Amortization is when you get your monthly payments for the fixed rate. For example, if you have a fixed payment, the fact that the initial payments would have more of interest component to it and then less of principal, and as if you keep paying your loan, the principal component will start reducing. So now you'll be paying more of principal and less of interest. That's the amortization, which breaks up your total payment schedule by interest and principal. So follow this. This is important. Let's take that example again of so like I don't have to type it again. The rate was what, 4% divided by 12. Number of periods is 360. Present value is $150,000. Future value 0. So I can type the value right within the formula in one cell, and it's going to give me the same answer. So for the first period, I'll just put 360, and then we can keep reducing the payment period. The original principal balance would be what? The complete loan amount, which is $150,000, right? Payment that you'll make would be this payment, which is the absolute value. And I'm going to, the reason I'm putting absolute is to take off that negative effect, and I'm going to anchor that cell, so when I copy it down, it's going to give me the same number. Interest charged would be the principal balance multiplied with 4% divided by 12. Yeah, this is correct. So $500 will be charged for interest, and so $500 from this will go towards interest. So I don't need this column towards interest because I've already calculated $500. Towards principal will be 716 minus 500. Ending principal balance will be this minus the principal, and this would be the starting principal balance for the next month, right? So my payment will still be the same. Interest charge will now be 4% divided by 12 on 149,783.88. Towards principal will now be $716.12 less 499.28. So the ending principal balance will be 149,567.03. So you can see that the reason it's taking a long time for the principal to reduce is because majority of the balance is being deducted for the interest component. So let's see, we can just now, so this is your amortization schedule. How much of the payment you're making is going towards principal and how much it's going towards interest. So you can see this, still you're not making any impact. You're not even at 50-50, right? Now you started paying more towards principal than interest. So I'm coming closer to the loan repayment. So finally, it's coming close to 30 years. There you go. And you know that your amortization is correct when at the the beginning period, the number one, the balance is 0. So you paid off your loan. So your amortization table is now good. One thing that I wanted to show you is just check. It took 30 years for you to pay off this loan, right? Now, what if you, instead of 716, you paid, let's say, $1,000. You added, you add maybe $265 more every month. What impact will that have? Exactly. So it'll be, let's say that now you have $1,000. Look at that. I paid off, by paying that $250 extra, I paid off the loan in close to what? 153 would be what? Divided by 12, 12.75 years. I cut, 18 years from my loan by paying $250 extra. So that's another lesson to be learned. Even if you're locked in a long-term loan, it's always good to pay that extra balance every now and then if you can, and that's going to help you in long term by saving on the interest which is being charged. There's a very famous saying in financial circle: interest saved is money earned. That is, if you can save on interest, that's like money earned. So I hope you will keep these things in mind when you get a loan for a car or a home or eventually. And even if you get locked in a higher interest rate loan, you can always keep paying extra. There's no law that will stop you from repaying the loan early. There's no penalty for it. So I'll leave it like that. What I'll do is I'm going to save the Excel sheet so that you can review what we had done in the class today. And something, I think, what has gone wrong is it is more than 716.12. So this is going to be so if you increase the number of decimal points, you'll see that, it's 1.1229. So that kept adding over for the years. And even on your loan, because you can't pay 0.229, so the last payment will have maybe a couple of cents extra or some dollars extra because of this reason. So let's now just scroll this down, and now it should be 0. There you go. So now you know that your amortization table is correct. Any questions? Another example, we can either do the same examples as in the PowerPoint, or I can take some examples which are very practical. Another example that we normally follow would be about retirement saving. Supposing you have an amount in mind that you want to save, and you want to know how much you would have to put away every month so that you can reach that amount. So that would be a future value question, because you're looking at a value at end of a certain time, either based on what payment you can set aside every month today, or we can work the other way around. Let's first try to find how much it'll add up to if you can set aside a certain amount every month. So again, NIY, present value, payment, future value. No, I'm just taking an example. I can follow the slides, but I'll just bring some relevant examples. So let's say you can save for another 25 years, for retirement, for the new ones coming in. And that will be 12, that's 300 months. And let's say you have you plan to invest in an index fund in the stock market, and traditionally, on average, you can get about 7 to 8%, on long term. So I'm just going to take 7%. So that's the monthly return. Yeah, so every month you're putting away, what amount do you want to put away every month? $500. And let's say on average, what, 7% would be a reasonable number, Robert, from the stock market in long run? So this is $500. So remember, when the money is going out, it'll be negative. This money is being invested in the index fund, which is sort of mimicking the entire stock market return, like S&P 500. So what will be the future value? And you will use the function called FV, which is FV, bracket open, rate is this amount, number of time periods 300, payment is negative 500, present value is 0, type 0. You'll be able to save close to $405,000 by putting away $500 every month for next 25 years. And this is the concept which is used for retirement accounts. Normally retirement accounts which companies will provide, 401k, they will allow you to put money in index funds, mutual funds, and those give you some sort of a diversified investment in various areas. Now let's look at the other way around. Let's say this didn't meet your expectation. Maybe you were thinking you will save a lot more. So let's put it the other way around. Everything else remains the same. You want to find out how much money you will have to put every month so that you end up with $1 million. You want to retire as a millionaire, let's say. So 100000. That's $1 million. So this is a payment question now. So it'll be PMT, rate is the same, number of time periods same, present value is 0. You don't have any money saved up as yet. Future value is $1 million, type 0. So you would have to put away $1,234.46 every month to be able to retire with $1 million. Pardon? So there are several ways of working around. There are 5 variables. You've got to know 4 to calculate the 5th. So now I can calculate pretty much anything. Let's say if I change the question a little bit, let's say that I'm trying to identify what kind of rate of return I should get in my investment, because that would depend whether I want to be an aggressive investor or a passive sort of a safe investor. If I'm putting my money linked to a S&P 500 account, I'm sort of a moderate, because I'm linking it to a stock market return. If I want to be aggressive, maybe I want to get into some, small cap, which are volatile sort of investments, but it kind of gives you high return because these are small companies and they may have a quick return as they grow. But it may also mean they may fall short if the companies fail. But nevertheless, let's say you're an aggressive investor, you want to understand what sort of return you should get. So this would be a rate question. So we don't know the interest rate in this question, okay? I know that I can only put away 750. I can't put away 1,234. So if I'm putting away 750 and I still want to end up having $1 million, what sort of rate of return should I get? Well, you can use rate and bracket open. Number of time periods is 300. Payment is minus 750, so I can put a minus here. Present value is 0. Future value is $1 million. Type is 0. Guess, just put guess 0. So this is, remember, monthly rate. Your yearly rate is going to be multiplied with 12. So you should get at least a return of 10.03. Students online, can you hear me? Okay. Okay, I had a student. Quincy, can you check your speaker if they're working okay? Because the rest of the class seems to be hearing fine. So you should get 10.03% return, annual return on average, to end up with $1 million. So that is being aggressive, right? On a risk return, linear relation. Remember we talked about that linear line, so it may not help if you are conservative in your investment. That's the reason why if you sit with an analyst, what would they recommend? In the initial part of your working life, they recommend that you be an aggressive investor, that is, put your money in some of the more aggressive return stocks. And then as you move towards your retirement, to move money away from aggressive investments to more safe investments, right? That was a big mistake that people did in the recent financial crisis. What people normally do is they put their money away and they forget. And every month the money is just going in those index funds and they never go back to review how the funds are faring. Now, if, for example, when market conditions change, you need to rebalance your portfolio. If you don't rebalance your portfolio, you'll end up with massive losses, as people did. And the other thing that they didn't do was diversification. Those kind of things we'll discuss in chapters to follow. Students online, everyone clear so far? So I think I've given enough indication. So this one is showing how to work on HP 10B, but I'm going to be using the Texas Instruments, the BA2 Professional and Excel, so that you can have an understanding. Yes. Present value could be negative when you're investing. When you are, for example, putting money away in some sort of investment, or you lending money to someone. Exactly, that would be negative. Buying a house is not negative because you are borrowing money for that. So money is actually coming in. You're not providing any money for that. If you were, let's say if Sharif is the buyer of the home and you are lending money to him, then your lending would be negative because you're giving money to him. The simple rule is if money is going out, it's negative. If money is coming in, it's positive. And if you have loan in that, then you take it positive because the bank is giving money to you. You're not giving money to the bank. If you are, let's say, depositing money in the bank, then that would be negative because it's money going out. So we have already covered this part, and we have covered this part. I've shown you how to do this. We have done through Excel also. So here's another question. It says, what's the present value of $100 due in 3 years if the interest rate per year is 10%? So what would be the variables in this case? What would be N in this case? Now in 3 years. It's a yearly thing. So it'll be 3. What about interest rate per year? IY. 10%, exactly. What about, what's the present value? What's the present value in this case? We don't know it because it's asking what's the present value of $100 due in 3 years. What's future value here? Future value is 100 because that's being discounted into today's money. What's payment? 0. There is no payment being made here, right? So you know 4 values, you can calculate the 5th, right? So you can use either of the ways, whichever way you like. Which one you want to use? Excel, calculator, Excel, okay. Oh yeah, you can. Whichever way you want to do, that's fine with me. I'm not going to. Whichever way you're comfortable with, you can do that. So it's going to be present value. Rate was 10%. Number of periods is 3. Payment is 0. Future value is 100. Type is 0. So it's going to be $75.13. That's the present value of $100 in today's money. So how can you use this information? It becomes useful in investment. For example, somebody comes and promises you, I have this excellent investment opportunity for you. Give me $80 and I'll give you $100 in 3 years. Why? Why is that? How did you find out? No, $100. No, in this context, this. So fair value of $100 today is $75.13. You should not invest more than $75.13. That should be the answer. Okay. So if somebody comes and asks, invest $80, and I'll give you $100 in 3 years, you'll say no, because you'll say an alternate investment is giving me $75.13. So why should I pay $80 to you? That's overpaying. So this is another way to value investments. Is it overvalued or undervalued? Because present value of $100 is $75.13. So you shouldn't pay more than $75.13. Right? Students online, everyone clear? $75.13. $75.13. So you can use whichever way you want. $75.13. finding time to double. So you want to understand how long will it take your investment to double if it's giving you a 20% rate of return. Any guesses? You're saying 72 months? Or it's close to that. It's close to 3.8. Close to that, but let's see how we can really find out. So this is going to be a question that involves solving for n, which is number of time periods. Okay, so let's say you have $1 and you want to know how long will it take to double it to $2 if you get a rate of return of 20%. So you take NPER, which is number of time periods. Rate is what, 20%? Right? Payment? There is no payment. Present value? Money going out. You are putting away $1. Now you will put negative because this is going to be money going out. Future value? Double, $2. Type 0. So it'll take 3.8 years to double your investment. 20%. Let me show you on calculator if in case you want to see an alternate way to do that. Okay. So let me just reset enter to clear up the memory. N I have to find out, so I'm going to skip for now. IY is 20, so 20 followed by IY. Present value is 1, so I'll press plus minus to make it negative, and that's present value. Payment is 0, so 0 payment, and then future value is 2. That's future value. Then compute N, 3.80. So either way, you will get the same answer. I mean, whichever way you are comfortable with, you can use. Okay. All right, students online, any questions so far? So 3.8. So this is another question, and what's the question here? It's an interest question, but if your money doubles in 3 years, if you want your money doubled in 3 years, what sort of interest rate you should get? And we know the answer is 25.99, but you want to calculate, we can do it quickly. Let's use the calculator. Second, reset, enter. What is N in this case? 3 years, right? You want your money doubled in 3 years, right? 3 followed by N. IY, I'll skip for now because that's what I want to calculate, interest rate per year. Present value is -1, so 1 followed by plus minus. Payment is 0, so 0 followed by payment. Future value is 2, 2 followed by future value, and then you compute N. Oh, it was compute IY. Oh, it's error, so I'll have to second reset enter. So I'll have to do it again. What happened? I messed up my own calculator. So N is 3, present value is -1, payment is 0, future value is 2, so compute IY. That's 25.99%. So you should get a rate of return of 25.99%. That's quite a bit. So that's the answer. You can use Excel as well by function called rate. Now we look at, a example of ordinary annuity versus annuity due. The differences in ordinary annuities payable at end of the time period. Most questions will apply ordinary annuity types, but in certain cases, annuity is due at the beginning of the time period. Like when you're paying for insurance, you're paying it at the beginning of the time period, not at the end of the time period, right? So in this case, the payment is made or received at beginning of the time period, whereas in ordinary annuity, payment is received or paid at end of the time period. So what's the future value of a 3-year ordinary annuity of $100 at 10%? We already seen that it was $331. And this is so this is in financial calculator. You can use that, or in Excel. I can show you. So this is in Excel. We have been using the type to be 0 or 1. That 0 or 1 basically decides whether it's at the beginning of the time period or end of the time period. So let me show you. So what is the question here? What is the future value of a 3-year ordinary annuity of $100 at 10%? So in this case, N IY, present value, payment, future value. So future value is unknown in this case because it's saying what is the future value. Present value is going to be 0 because nothing is being started with. IY is 10%. Payment is $100 because that's being made, or that's being received every year, and this is for 3 years. So ordinary type, is it 0? It's at end of the period. So it's $331. If you want to buy this annuity today, it should be no more than $331. What if it's annuity due? In this case, type will be at the beginning of the time period. So it's going to be $364.10. Why? Because it will be paid at the beginning of the time period and not at the end of the time period. Okay, is everyone clear between the difference of the two? So let me show you back in the exercise in the PowerPoint. So this is for ordinary annuity, okay? And then if you go to slide number 41, I mean, this is just explaining how to do all that. So let's go to the slide number 41, and this is for the annuity due. Okay, students online, everyone clear? So in calculator, you know, the way you can set your calculator for ordinary annuity and annuity due is by setting the end and the begin function. You know, that I can show you. I think the way it will happen is second and then begin and that enter and second begin, and I think it's second here. So second enter. So that toggles between begin and end. Second enter will give it end. Second enter will begin. So now you can toggle between the two. So I'll leave it at end because we're going to be using most of the questions set to end. So if you're doing some questions for, I think that may be the problem in your calculator. Is it set to begin or end? Okay, we can check after the class. But make sure when you set your calculator to begin to reset it back to end. Otherwise, it's going to give you wrong answer. So you see this is for annuity due. So why is there a difference between the two? Because of the fact that payment is made at beginning of the time period, so that will accrue interest, and the other one does not. So I've shown you this. What is the present value of uneven cash flows? Now we may have situation where you have uneven cash flows because right now we are assuming that there's going to be one cash flow. So in this case, for example, there's several ways of doing that. And let me show you in Excel. So you have so $100 is being paid at end of period 1, $300 paid at end of period 2, $300 paid at end of period 3, and $50 is paid out in period 4 because it's got a negative sign. So you got to discount these in today's value. One thing you can do is just simply discount all of them. So this is going to be $100 divided by 1.1, because this is at 10% raised to the power 1. Right? So it's discounted to $90.91, and I can just now copy it down. And those are my present values for these numbers, and then I add them, which is $530.09. Okay, did everyone understand what was going on here? Well, the $50 is negative, so it will be discounted to a negative value, which is $34.13. This is going to be negative. So this is money going out. So you're discounting it. So the negative value will be reduced by discounting it. Right? And you're paying out $50. Yes, 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 yes. But on the negative side, negative reduces, because you have 0 here, positive comes down, negative will come down on this end. So that's $530.09. And we can also use a function called net present value. The rate in this case is 10%, comma, and the value are all these values which can come together, which is again the same number, right? So you can do it in one function. Instead of doing it individually for each cell, you can use a function called NPV, net present value. The way you use it is, again, I'll show you. For example, if you wanted to understand the net present value for these cash flows, do equal NPV, bracket open. It's asking for what? The first thing it's asking is rate. We know rate is 10%, comma, and then it's asking for all the values. So I can just copy all the values, highlight all the values, bracket close, enter, and this is the same number. So this is to save your time, right? You don't have to do individually. Yes. And the good thing about Excel is, in case you get confused or say, hey, I don't understand what's going on, let me see how we can get here. So this question mark, depends on which Excel version you're using. I've never used it in this version, but you have Microsoft really does a horrible job about explaining things, but they got this thing right. Is Excel, the help feature in Excel is really good. So for example, you forgot how to use the function, just click on that help feature. And let's say, students online, can you view the Excel help feature that's come up? So if you just, let's say, type in future value. So you see that is going to give you an explanation of what the future value function is. It'll give you the explanation of the syntax, explaining what rate is, what NPER is, what payment is, what present value is, what type is, and again, end of the period, beginning of the period. And it also gives you an example. You can copy and paste this example in Excel, and you can work out an example. So Excel is really good. If you want to learn Excel, you can just follow its help, and that's more than sufficient. Okay, blank box. So now can you view Excel help, Tamika? Oh, blank box. So try one thing. Let me see if I can do that. Okay, now can you view the Excel help? I'm sharing my entire desktop. Okay, so this is, the way I got this is just by clicking on this question mark here. It's going to pop up that Excel help box. And now let's say if you wanted to understand how to use future value, you can simply type FV and enter, and it's going to give you the FV function help. Click on it, and it's going to give you all the syntax use. This is the same thing that we were using in the class today. Explanation of the variables, and then even an example, so you can copy paste this example and work out in Excel. So there are like hundreds of functions in Excel, and it's a really powerful software. We just think it's a software to maintain, accounting, books, but you can do advanced financial, modeling. You can do so much in Excel. I've taught an entire statistics class using Excel. I've taught a management science class using Excel, and I use Excel for economics, finance, investments, and all the things, because it has all these excellent functions that can be used. Okay. All right. I think what we're going to do is, did we have enough fun for the day? I think I covered a lot of material for today, right? So what I'm going to do is I'm going to stop. I think we're at the halfway point. It's not humanly possible for me to go on for 95 slides. I'm going to stop here at 45 slides, but yeah, we already have students saying, my mind is blowing up. Yeah, so I saw students in class also kind of, okay, I don't want to lose students in class, so I'm going to pause here. But what I want you to do is, A, review the material that we have covered today. If you do not review the material, you obviously will not understand what will happen in the next chapter, or even the follow-up questions, the slides which we'll cover. But one thing that I wanted to cover is go back and discuss some of the assignments which are expected of you in this class. So Deborah, just call me and I can go over any material that you want review with. Because I want you, all of you to, review the lecture again. That would be the best thing to do. Go back and review the entire lecture again, this time practicing the questions we've done. Because this is, yeah, there will be sufficient. I mean, see, obviously this is not a survey class. I would have assumed that you already knew about time value of money. I should have completed this in the first half of the class. But I knew, looking at students' faces, that you probably need a review in time value of money, right? In this class, if there is one chapter, or even in finance, if there's one chapter, even if you don't understand anything, if you can master just one chapter, it's time value of money, you would have, taken 80%. I would have felt satisfied. I would feel satisfied if you mastered just this one chapter, time value of money. It's that important. Time value of money. Yes. Yeah, because it's not just for academic purposes. This is going to stay with you for your entire life. Every day. I mean, you are a business owner. If you have to borrow funds, if you have to invest, you're going to be looking at what's going to be the cost of loan over 10 years, 5 years. That's how you're going to make a decision about investing, right? So this is a very important chapter. And you see the formula that is in front of all the chapters, the first slide, that is present value equals to future value divided by 1 plus r raised to the power t. It's that important. The entire valuation system or the mechanism depends on time value of money. So let's go to the class. Students online, can you view the class page that I've opened up on the browser window? All right, couple of things that I'm expecting. I've already covered 3 chapters, and this is the 4th one. We've covered half of it. For students who missed, to go to Blackboard Collaborate, go to the recordings, and review all the recordings that you missed. This is important. Right from the first recording, which is covering discussion of the syllabus and all aspects of it. And these are available. All recordings are available here. So review that. Then assignments. There are 3 assignments. First is the homework assignment. For the last 3 chapters, those are already posted. Chapter 1, 2, and 3. But don't start working on the assignments before you've reviewed the lecture. Okay? Otherwise, you'll get lost, If you want, I mean, all of these were due today, 22nd, but some students asked for extra time. So I can postpone it until the 29th, next week. Next week, we won't have a live lecture class because I have to go on a site visit. We won't have a class next week because I won't be available here to deliver a live lecture. So use the next week's Tuesday to complete all your missing assignments. Catch up and finish up everything. Well, go over and see if you made any mistakes and review them. Okay. If I can, what I'll do is I'll try to post a recording of the remaining slides, but I want to cover that in class, because otherwise I would not be able to see you and see where you are finding it difficulty. Maybe I'll record some other lecture and post it, which probably you can get for the next class. But I want to give the next week for you to finish up any missing assignments or pending assignments. Is that fine, students online? Yes, I'll have access to email, yes. Okay, so the other thing is term paper. Now, term paper proposal was due yesterday, and at that stage, I wanted you to at least submit a topic of interest, research questions, data sources, and a proposed methodology. If you have not done it, again, I'm going to extend the deadline to next Tuesday. But this is going to be a firm deadline, you know, next Tuesday. Just the proposal. I've broken down, you know, when what is due. So you can go to this folder and you can see that you got these different aspects posted in link. This is due next week on 29th, yes. The other thing which is due in the PBS Frontline case study would be case study number 1, which is Money, Power, and Wall Street episode 1. Have you all watched this? That's going to be due next week as well. It was due today, but well, is it interesting? That's what I thought. When you watched all 4, you will understand, you know, what was going on, and the irony is the very things which we were dealing, you know, 6 to 7 years back and had thought had gone away is coming back again. You just watch the first part. You'll be shocked when you see part 2, 3, and 4. And the funny thing is, you know, people were just pushing buttons. They didn't know what was happening, and you know, they were called what was going on, and they were getting bonuses in hundreds and thousands of dollars. You know, so they were making close to $100,000, $200,000 just for pushing buttons, and they didn't understand what was going on. Well, we quite think very highly of Wall Street. We know exactly what most of the time happens, right? It's all luck. Job is hard. You know, it's more about Wall Street is about who you know. Wall Street is all about who you know there. If you know someone, it's easy to get in. Okay, so that is another thing that all of you should work on if you've not started working on. One thing that I'm a little surprised is you've not been participating in the discussion post. So I already have discussion boards are again due next week. Everything is due next week. You got 4. And then when we come back, we're going to have our midterm exam pretty soon. Let me see.
So we know all this information that you just gave us here, we should have no problem with the midterm exam.
No, you shouldn't have any problem with your midterm exam. So when you come back, Midterm exam is going to be between 5th and the 9th. So this is going to be, that's going to be, so 29th next week, we won't have a class. And 5th would be your midterm exam. I'm sorry, 6th will be your midterm exam. So the midterm exam will cover chapters 1, 2, and 3. Because 4th chapter, we still haven't covered the entire of it. So maybe I'll cover half of the 4th chapter, some of the 4th chapter that I've covered. The way I normally have my exams is 1, 2, 3, and half of 4th. Oh, you're going to be fine, don't worry. If you can trust the Wall Street bankers, can't you trust an instructor? So here's how you will do your midterm exam. You would go to the tests folder and then go to the midterm exam folder, and you'll find a link there. You will click on the link and the exam will begin online. You don't have to come to class for the exam. It's going to be an open book, open mind, open PowerPoint, open notes, everything you want, that's fine. But no discussion with each other. No discussion with each other. This is your exam. And it's going to be a conceptual exam. So I'll have about 30 questions, 30 to 35 questions. You will have 3 hours, full 3 hours to attempt your exam. Now what you can do is, if you also give me a scan of your scratch sheet, if you want, you can do it. You don't have to. So I look at the scratch sheet and see that, okay, this student has applied the formula, the correct formula, but maybe didn't get the final answer by solving it. So I'll give you a partial credit for it. So for example, if you had to apply a time value of money formula and you applied it correctly, but you couldn't get the right answer, I will give you partial credit for it. Now, one thing that I also do is, yes, Chandra, this is going to be timed. This is you will get full 3 hours, for your exam, or 2 hours 45 minutes, but I give 3 hours, so you can use the 3 hours. You have to be connected to the internet because this is an online exam. If you think that you don't have stable internet connection at your home, you can come to campus and take the exam. What I'll do is I will open up the exam on the 2nd, so that sometimes you may be busy on Sunday or Saturday, so at least you can work on Friday. Okay, so you have Friday, Saturday, Sunday, Monday, and Tuesday. No, you have to take the exam in one go. You have to take it in one go. You come back and retake the exam. Well, if you think that you may not be able to take the exam online, come to campus. I can have a walk-in exam ready for you. These are some of the part and parcel of technology, but it has got really good. I mean, for the last year or 2 years, I've never had any student complain that the internet is down or the link has disappeared or something has happened. Blackboard has become really stable for last 2 years. Deborah has a very good question about how many chances. Now what I do is I also give you another chance. So for example, if you take the exam and you don't pass it, I'll give you I'll give you. I'm one of the easiest of professors to get along with. I make life so easy for anyone. That's why nobody respects me. Nobody, says that, okay, you are being nice to us. I think I'll have to be strict. But okay, you'll get 7 chances. You can take the exam 7 times. The reason I'm doing it is it may be a technical problem. Let's say, for example, the internet, where you may be in some area where the internet is not stable. So you start taking the exam, you get a power disruption, so for technical reason. Or maybe you scored less and you want to retake it. You retake it. But there's a catch to it. If you retake the exam and the grade you get in the follow-up exam will be the one that gets recorded. So you weigh your options and chances. So in one exam you got 80. Do you want to retake it? Well, it depends. If you want to maybe get 85. But if you scored 75, then 75 gets recorded. No, because the system will lock you at seventh time. No, the difficulty will not increase because I know I've selected the questions. They're going to be in a pool, so it'll be randomly presented to you, and that's fair. That's fair because one student will get the same question, then the other student, maybe the numbers are changed, and the difficulty level will be the same because I've selected the difficulty level. Okay, everyone, students online, is everything okay? Is it fair? I think I'm pretty fair with it. Now, another thing that I'm going to do is, if, for example, the highest scoring student in the class got 70 in the exam, so that means that it was a tough exam. I'm going to curve the grade. So I'm going to make that 70 to 100, and everybody will get 30 extra points. Okay, fair? So now we are talking about, all types of avenues to. Well, the idea here is the idea here is not for getting the grade. I mean, if all of you want an A, I'll give you an A. That's not a problem. It's understanding the material. That's what I want. I want you all to understand what's really happening in the chapter, and this is something that you will keep with you all your life. So, you're going to use in your business, somebody will use in their work, another person might use it for investment purposes. You're going to be using all this information in your retirement account to manage your retirement account. If you're not reviewing your retirement account, you should be doing it. You should be reviewing your retirement account every 6 months at least. I know so many people who have never gone back to review their retirement account. They don't know what's invested, where it's invested. And majority of those people lost money in the recent financial crisis. So this is for your own benefit, this is a learning exercise. I mean, if you knew everything, why would you be here in the class? So that's what I want. That's my teaching philosophy, is to really equip you with the understanding to use the tools. I don't want you to memorize the formulas, because you'll have, nowadays if you want a formula, you can just search on the internet. It'll come right on your cell phone, or it's going to be in the book. But how you use the formula and what you make in terms of sense of the formula is important. All right, any questions? And the link will be automatically coming up on the 2nd of October, and I'll send a reminder email. It'll be in the announcements page, but it's your responsibility to go and start taking the exam. Yes.
You're not going next week posting the lecture for the second half. Is that
No, I'm not, because I think this lecture will have to be delivered live. Because if you want, I can record the lecture, but I think most of you will not benefit if I record the lecture and post it, because you may want to, I want to see all of you to see if you're understanding the material or not. I mean, to
I'll see you teach it, and I can watch it on.
yeah, to cover, what I can do is I can record something else which will be more easier to understand just through recording. So you like to see me every week. See, there's a good student. There's a good student, you know. Okay. All right. Thank you so much. I really appreciate that. Really appreciate that. Okay, students online, any other questions? I think all of you are doing wonderfully, well. I know this is not the easiest of courses. This is one of the toughest courses. And I'm trying to just make it as easy as possible, interesting as possible for all of you to understand, because you will benefit, from what you learn. Okay, thanks a lot, everyone, for participating and making it equally interesting for me, because if I don't see students participating, I can't make it interesting as well. So thank you for participating, and if you have any questions, let me know. Thank you for that. And we will be now, even though we'll be in communication through email or other sources, I will not see you on the 29th. And what we can do is we can have a class on the 6th. You take the exam, but we'll have a class on the 6th. I'm giving you enough time to cover up we'll have a class on the 6th and finish up that chapter, all right? So I'll see you on the 6th. Because I don't want to be away for a long time, because, you all miss me so much. All right, thank you so much, and I'll see you on the 6th, okay? Thank you, bye-bye.